I have been selling bank stocks. If you have followed my moves at Berkshire Hathaway over the last few quarters, you might have noticed something strange. For decades, I loved banks. They were my favorite business. I bought Wells Fargo, I bought Bank of America, I bought US Bancorp. I liked them because they were simple money-making machines. But lately, I have drastically reduced our banking exposure. And when a man who has loved a sector for 50 years suddenly starts heading out the back door without making a sound, you should ask yourself why. The short answer is the game has changed, and the long answer is what I am going to tell you today. Most people believe that the banking crisis ended in March 2023 when Silicon Valley Bank and First Republic collapsed. The news reports said the government stepped in, that everything was under control, and that the system was safe. People went back to sleeping soundly, but I am not sleeping soundly. What we saw in 2023 was not the end of the crisis. It was the first tremor of a much larger earthquake brewing beneath the surface. There is a rule in business: there is never just one cockroach in the kitchen. If you turn on the light and see one running, I guarantee you there are hundreds more hiding behind the walls. Silicon Valley Bank was the cockroach we saw. Today I want to talk to you about the ones that are hiding. The American banking system, and much of the European one, is divided into two worlds. You have the too big to fail, JP Morgan, Bank of America. These have the implicit backing of the government. If they have problems, the Federal Reserve will print infinite money to save them. They are almost departments of the state. But then you have the regional banks, thousands of small and mid-sized banks that are the engine of the local economy. And these banks are walking toward a mathematical precipice from which many will not be able to return. I am not telling you this so that you panic and stuff your money under the mattress. I am telling you this so that you are selective. Because in the next crisis, not all banks will be bailed out. And if your money, or worse, if your stock investments are in the wrong bank, you can lose it all. When a bank stock fails, it doesn't go down 20%, it goes to zero, it disappears. I have identified three types of banks, three categories of financial zombies that you must avoid at all costs. If you have shares in them, sell them. If you have deposits above the insured limit, $250,000 in them, move them. The first type of bank on my blacklist is what I call the landlord bank. To understand the danger here, you have to look out the window. Go to the center of your city. Look at the office buildings. What do you see? You see lights out, you see for lease signs, you see entire floors empty. Remote work changed the world forever. Companies realize they don't need expensive glass towers to function. Demand for offices has collapsed. In cities like San Francisco, New York, or Chicago, the vacancy rate is historic. Now, who do you think owns those buildings? Or rather, who lent the money to build them? It wasn't the big Wall Street banks. They were smart and got out of that market years ago. It was the regional banks, the local banks. They hold almost 70% of all commercial real estate debt in the United States. We are talking about trillions of dollars in loans. And here is the death trap. These loans are not like your 30-year fixed rate mortgage. They are commercial loans that mature every 5 or 10 years and must be refinanced. Imagine being the owner of an office building. 5 years ago, the building was full, and you were paying a mortgage with a 3% interest rate. The business worked. Today, the building is half empty, your income has dropped by half, and the bank tells you that to renew the loan, you now have to pay an interest rate of 7 or 8%. Now, the math is impossible. The building owner cannot pay, so he does the only thing he can do. He hands the keys to the bank. He says, here, the building is yours, I'm leaving. And suddenly, the bank, which is supposed to manage money, becomes the owner of an empty skyscraper that nobody wants, and that is worth half of what they lent. If a bank has too many of these loans on its books, it is insolvent. Technically, it is broke. The only thing keeping it alive is that it hasn't yet had to mark the real value of those buildings in its accounting. They are playing a dangerous game called extend and pretend. They renew the loans a little longer, praying that rates go down or tenants come back. But praying is not an investment strategy. If your local bank has massive exposure to the office and commercial sector, it is a ticking time bomb. You have to look at its quarterly reports. Look for the acronym CRE, Commercial Real Estate. If you see that CRE loans represent 300 or 400% of their total capital, run, do not walk, run. That bank is betting its survival on the real estate market miraculously recovering. And I don't bet on miracles. I bet on facts.
In 2008, the problem was the mortgages on normal people's houses. This time, the problem is the buildings where those people used to work. The asset is different, but the result for the bank is the same: insolvency.
And the worst part is that these regional banks do not have the capacity to absorb these losses. A JP Morgan can lose $10 billion on offices and keep making money with credit cards and investment banking. A regional bank in Ohio or Texas doesn't have other businesses to compensate. If the brick falls, the bank falls. In the next part, we are going to talk about the second type of dangerous bank. This one is even more treacherous because it looks modern and successful right up to the exact day it dies. It is the concentrated niche bank. It was what killed Silicon Valley Bank in 48 hours. And I am going to explain why modern technology has made bank runs 1,000 times faster and more lethal than in my grandfather's time.
Let's talk about speed. In the old days, when a bank had trouble, people had to physically run to the branch, stand in a line that went around the block, and wait for a teller to give them their money. Those lines created friction. They gave the bank time to react, to call other banks, to look for liquidity. The panic was analog and slow.
Today, panic travels at the speed of light.
The second type of bank you should avoid like the plague is the concentrated niche bank. This was exactly what killed Silicon Valley Bank. It wasn't a bad bank in the traditional sense. They weren't stealing money. They made a much more subtle mistake. All their clients were the same. They were tech startups and venture capital funds. Everyone knew each other. Everyone was in the same WhatsApp groups and at the same parties. When the rumors surfaced that the bank was in trouble, it didn't take a week for the news to spread. It took a single tweet. In a matter of hours, $42 billion left the bank. $42 billion in a single day. No bank in the history of humanity, not even the most solid one, can survive a hemorrhage of that magnitude.
Your mobile phone is the most dangerous weapon for a bank today. With 3 clicks on your banking app, you can move millions of dollars from a regional bank in danger to a giant like JP Morgan. Bank loyalty is dead. The ease of transfer is total.
The danger here is the lack of diversity. A healthy bank should be like a diverse forest. It should have the butcher, the baker, the teacher, the large corporation, and the student. When the butcher takes money out, the teacher deposits it. They balance each other out. But there are banks nowadays that specialize in trendy sectors. You have banks that serve the cryptocurrency industry almost exclusively. Banks that serve the cannabis industry because the big ones don't want to touch them. Banks that serve only ultra-wealthy families in a specific area. If you have your money or your stocks in one of these niche banks, you are sitting on a powder keg. Why? Because your fellow depositors all think alike. If there is a scandal in the crypto world, all of that crypto bank's clients will get scared at the same time. There will be no one depositing to compensate for those withdrawing. It is a synchronized stampede. And here is a technical indicator that I want you to look for. It is a number that banks are required to publish, but almost no one looks at the percentage of uninsured deposits. As you know, the government, the FDIC, insures your deposits up to $250,000. If you have less than that, you are safe no matter what happens. But companies and wealthy clients have much more than that. Those are the uninsured deposits. If a bank has a very high percentage of uninsured deposits, say 80 or 90%, it means its client base is very nervous. Those people know that if the bank falls, they lose their money. So at the first sign of smoke, they run. They are hot money. Silicon Valley Bank had more than 90% uninsured deposits. It was a house of cards waiting for a breeze. If you see a regional bank boasting about being the exclusive bank for industry X or the preferred partner of sector Y, be careful. Specialization, which is good in other businesses, is fatal in banking. Banking needs boredom and diversity. I want to make a special mention of banks exposed to cryptocurrencies. I have nothing against blockchain technology itself as an experiment, but as a banking business, it is poison. Volatility is extreme. Frauds are common. Regulation is uncertain. If a traditional bank decides to start accepting massive deposits from cryptocurrency exchanges to look modern and attract quick capital, it is importing a virus into its system. When the price of Bitcoin drops 50%, or when a regulator sues a crypto company, that bank is going to suffer a run. Do not invest in banks that play at being casinos. Banking is a business of trust, and trust in the digital age is the most fragile thing that exists. It takes 100 years to build and 5 minutes on Twitter to destroy. Now let's move on to the third category. This is perhaps the hardest to detect from the outside, but it is the one that causes me the most anger, because the first two categories, real estate and concentration, can be miscalculations or economic bad luck. But this third category is pure human incompetence and greed. I am talking about the bank with mismanagement and weak governance. There is an infallible signal that tells me when I should flee from a bank, and it has to do with what its executives do with their own money and with the shareholders' money when they think no one is looking. In the next segment, I will teach you to read the smoke signals emitted by corrupt or inept managers before the ship sinks. We arrive at the third category on my blacklist. This is the one that bothers me the most, because it is not about honest miscalculations, but about arrogance. I am talking about the bank of rapid growth and mismanagement. There is a phrase I have repeated for decades: in banking, rapid growth and safety are incompatible. If you see a bank that is growing 20 or 30% a year while the economy is only growing 2%, I guarantee you they are doing something wrong. Banking is a boring business. It is a commodity. Money is the same everywhere. To grow much faster than your competitors, you only have two options. Either you are lowering your standards to lend money to people who aren't going to pay, or you are taking hidden risks in your investments. When I analyze a bank, the first thing I look at is not its earnings, but its speed. If I see a small regional bank that suddenly wants to conquer the world, buying other banks, opening branches like crazy, and lending money for speculative projects, I stay away. They're driving a car at 200 kilometers per hour on a road full of ice. They might arrive quickly, or they might kill themselves on the first curve. And here, the human factor comes in. You have to watch the managers. There is a red alert signal that never fails: insider stock selling. Before First Republic Bank collapsed, its executives sold millions of dollars of their own shares. The same thing happened at Silicon Valley Bank. They went on television saying, "The bank is solid, we are better than ever, trust us." But in private, they were calling their stockbrokers to sell everything they had. Don't listen to what they say. Look at what they do with their own portfolio. If the CEO of your bank, the CFO, and the board members are selling stocks massively, why the hell are you keeping your money there? They have the real information. If they jump ship, you should have jumped yesterday. Another sign of mismanagement is reckless share buybacks. I love share buybacks when a company has excess cash and the stock is cheap. But I have seen banks buy back their own shares at all-time high prices, burning through their reserve capital just to artificially inflate the stock price and collect their year-end bonuses. That is corporate looting. A bank needs capital to survive storms. If management spends that capital on parties for shareholders, buybacks, instead of saving provisions for bad times, that bank is going to go bust in the first recession. It is like a family spending their life savings on a luxury vacation just when they know the father is going to lose his job. It is irresponsible. And finally, within this category of mismanagement is the stupidest and most common technical error: duration mismatch. It sounds complicated, but it is simple. Banks take your money deposits, which you can ask for back at any time, and invest it in loans or bonds at 10 or 30 years, long-term, to earn interest. If the bank invests all your money in 10-year government bonds paying 1%, and suddenly interest rates rise to 5%, as happened recently, those old bonds lose value. If the bank has to sell them today to give you your money back, it loses a fortune. This is basic risk management. It is banking 101. And yet banks with supposed experts on their boards committed this rookie mistake to the tune of billions of dollars. Why? Greed. They wanted to earn a few extra cents of yield while ignoring the risk that rates might rise. Remember my other famous quote: only when the tide goes out you discover who's been swimming naked. High interest rates are the low tide. And now we are seeing that many regional banks were completely naked. They managed their balance sheets assuming that money would always be free. They were wrong. And the penalty for that mistake is corporate death. So, recapping the blacklist: banks full of loans for empty offices, niche banks concentrated on nervous clients, banks with aggressive managers who sell their own shares. If your bank meets any of these characteristics, or worse, all three, your capital is in danger. But Warren, you will ask me, how can I know all this? I am not a financial analyst. I don't know how to read a complicated balance sheet. You are right. Banks do everything possible to hide this data in footnotes with small print. But you don't need to be a genius to protect yourself. I have designed a 3-step survival test. These are 3 simple questions you can answer today using Google and a bit of common sense. In the next segment, we are going to perform this test together. We are going to see if your bank is a fortress or a house of cards. And I will tell you exactly where I have my personal money and Berkshire's money right now to sleep soundly, because there is a place that is safer than any bank.
All right, let's stop talking about boring balance sheets and get into action. You have money in a bank. Maybe it's the bank your father used. Maybe it's the one with the ATM closest to your house. And now you are wondering, will my money be safe when the storm hits?
You don't need a master's in finance to find out. You just need to answer these 3 simple questions. This is my bank survival test. Question number 1, is your bank too big to fail? This is the unfair political reality of the American system. There is an unofficial list of banks that the government considers systemic. J.P. Morgan, Bank of America, Wells Fargo, Citigroup. If one of these banks catches a cold, the government gives it medicine immediately, because if they die, everyone dies. If your money is in one of these giants, you can rest relatively easy. Customer service might be terrible, fees might be high, but your money isn't going to disappear. They have the implicit backing of the Federal Reserve. But if your bank is regional, local, or a trendy online bank, you don't have that parachute. You are flying solo. If that is your case, go to question 2. Question number 2, what does the stock price say? The stock market isn't perfect, but it is a very efficient information processing machine. If there are problems at a bank, the insiders and hedge funds know before you do, and they vote with their money. Go to Google Finance or Yahoo Finance. Type in your bank's name. Look at the price chart for the last year. If the S&P 500 has gone up 10%, but your bank shares have gone down 30, 40, or 50%, read the alert. The market is screaming at you that there is a problem. When a bank's stock nosedives without there being a general recession, it is like seeing smoke coming out of an airplane engine. Don't wait to see the flames. If the stock is sinking, get your money out. It is the canary in the coal mine. Question number 3, are you above the limit? This is the golden rule. The FDIC insures up to $250,000 per deposit or per bank. If you have $249,000 in a bank that goes bust tomorrow, nothing happens. On Monday, the government returns your money. You will sleep well. But if you have $300,000 or $1 million, maybe you sold your house or business recently, everything above those $250,000 is at total risk. You are an uninsured creditor. If the bank fails, you will get in line with everyone else to see if you recover cents on the dollar 5 years from now. Never, under any circumstances, keep more than $250,000 in a single bank. If you have more, open an account at another bank and split the money. It is the most basic and free risk management there is. Now, suppose you take the test and realize you don't feel safe. Your bank is regional, the stock is falling, and you have a significant amount of cash. Where do you go? Many people make the mistake of taking the money out of the bank and putting it under the mattress or in a safe. That is a mistake. Inflation will eat your purchasing power, and the risk of physical theft is real. There is a place where I, Warren Buffett, keep the vast majority of Berkshire Hathaway's liquidity, more than $100 billion. It is not at J.P. Morgan. It is not at Bank of America. It is in U.S. Treasury bills. Why? Because a Treasury bill is the safest investment on planet Earth. When you put money in a bank, you are lending money to a private corporation that can do stupid things with it, like buying empty buildings. When you buy a Treasury bill, you are lending money directly to the United States government. The bank can fail. The government technically cannot fail in its own currency because it has the machine to print bills. If the Treasury has to pay you, it will pay you. Those dollars might be worth less due to inflation, but they will pay you. The default risk is zero. Furthermore, in the current environment, short-term Treasury bills, 3 or 6 months, are paying a higher interest rate than most bank savings accounts. It is the world upside down. You get more safety and more yield at the same time. That is why every Monday morning at Berkshire, we buy billions in Treasury bills. We do not trust bank balance sheets to hold our war chest. We trust the faith and credit of the United States. You can do the same. You can buy Treasury bills directly through treasurydirect.gov, or even easier through your brokerage account or via a short-term bond ETF like SQWIB or BLA. It is simple. It is liquid. And it allows you to sleep at night knowing that it doesn't matter if your bank's CEO goes crazy or if the real estate market collapses, your money is backed by the Treasury. But be careful. Not everything is black and white. There is a psychological trap that investors fall into when they flee from banks. They go to the other extreme. They go into purely speculative assets thinking they are havens. In the last part of this analysis, I want to talk to you about what you should not do with the money you take out of the bank. Many people are fleeing towards gold and Bitcoin. I will give you my honest and brutal opinion on these assets in a banking crisis. And I will give you my final prediction on what will happen to the banking system in the next 2 years and what the financial map will look like when the dust settles. When people lose faith in banks, fear often pushes them into the arms of peddlers of smoke. I have seen this time and time again. They take their money out of a regional bank in danger, which is smart, but then they make the fatal mistake of putting it into assets they don't understand, thinking they are outside the system. Let's speak clearly about gold and Bitcoin. Many people will tell you that when banks collapse, gold and Bitcoin will go to the moon. And they may be right in the very long term about dollar devaluation. But at the exact moment of a banking crisis, something called a liquidity crisis occurs. When the system freezes, everyone needs dollars. Companies need dollars to pay payrolls. Investors need dollars to cover margins. And when everyone desperately needs dollars, they sell whatever they have to get them. They sell stocks, they sell bonds, and yes, they sell gold and cryptocurrencies. In the 2008 crash, gold fell almost 30% at the beginning of the crisis. Bitcoin, being a risk asset, behaves more like a tech stock than a reserve currency in these moments of panic. Do not confuse investment with emergency fund. Your emergency fund, the money you need to live for the next 6 or 12 months, cannot be in something that can drop 20% in a week. It has to be in Treasury bills or in an insured systemic bank, period. If you want to own gold or Bitcoin as a long-term bet, do it. But don't bet your rent money on it thinking it is a magic shield against bank failure. So what is going to happen now? What is the future of the American banking system? I think we are seeing the end of regional banking as we know it. The pressure is too great. Regulation will become stricter, capital costs will rise, and office buildings will remain empty. Small banks simply won't be able to compete. We are heading towards a great consolidation. Of the 4,000 banks that exist in the United States today, I think we will see half disappear in the next decade. Not all will fail spectacularly. Most will be absorbed. The big fish, JP Morgan, Chase, will eat the small and medium fish at bargain prices.
The result will be a system with fewer options, less personalized service, and more power concentrated at the top. It will be safer, perhaps, but also less dynamic for the small local business owner who needs a loan and doesn't fit into Wall Street's algorithm.
Your job is not to fix the banking system. Your job is to survive the transition. Remember the rules of our blacklist. 1, flee from banks loaded with toxic real estate offices. 2, flee from niche banks concentrated on nervous clients.
Flee from banks where executives sell their own shares.
Remember the golden rule of survival. Diversify your deposits, never exceed the insured limit, and use Treasury bills as your true bunker. The banking crisis isn't over. It is only paused. High interest rates continue doing their work of erosion. Slow but sure on the balance sheets of weak banks. One day you will wake up and see on the news that another surprise bank has fallen. That day I want you to watch the news with peace of mind, knowing that your money isn't there, knowing that you did your homework, knowing that you are the captain of your own capital. Money is freedom. Don't let a mismanaged bank take it away from you. Thank you for listening to this warning. I hope you take action today. Check your bank, take the test, and sleep soundly. See you in the next analysis.